Howdy, Jacob here. Today we're going to do an not in-depth, sorry, we're reviewing Dollar Tree, but I will be doing a comparison with Dollar General as they're pretty similar businesses in the consumer staples distribution and retail industry. They basically sell a bunch of things cheap, and so I think it'd be a reasonable comparison to compare Dollar Tree and Dollar General. And so first thing I want to look at is Dollar Tree's. We'll go through Dollar Tree and then we'll do some comparisons afterwards. So Dollar Tree growth, very impressive. 8.6 billion in revenue to 30.6 billion 2024. It's been very consistent. It's one of those things they probably just increase things with inflation, or maybe they increase their stores 2 to 3% a year, and it's been going well for them. The gross margins are very consistent in that 29 to 31% range outside of 2015. It's very consistent. Operating margin is a little bit lower. Used to be that 6 to 9%. Most recent year, they had trouble. So we'll see if that's a one time expense or not. Return on invested capital, okay. Probably upper single digits, maybe 7 to 9% there. Their balance sheet shows 685 million cash on hand with no short-term debt, 3.4 billion long-term debt. Capital leases not concerned about since it's pretty common for this type of business. Their free cash flow is growing very well, but their capital expenditures are also growing. So this other is they're going to be their CapEx. Again, don't know why QuickFS does this, but sometimes. But we do see CapEx very high in the most recent years, still producing free cash flow, and they're buying back shares very heavily. So majority of their free cash flow is going towards share repurchases, and it is going to be pretty much everything that they earn is going to share repurchases. So a little bit of debt pay down, not as much recently, but right now it's just buying back shares. So let's do a quick comparison here. So revenue 8.6 to 30.6 is massive. And Dollar General 18.9 to 38.7, also very large. Not quite as much growth as Dollar Tree, but very large growth still, with gross margins of 30 to 31%, very consistent. That's very much in line with what we're seeing here. Operating margin of that 7 to 9% on Dollar General is pretty much, 8 to 9, 8 to 10%, so a little bit higher in the most recent year, 6%. So they have a little bit higher here, but we can see that there's still a problem going on the most recent year. I did want to look to see if this was a one-time expense or whether it was something else. So yeah, they did decrease. They had other non-operating income of minus $1 billion, but even outside of that, sales, general, and admin jumped humongous. There was a massive jump from 6.7 billion to 9.1 billion. Let's see if Dollar General had that same quote unquote problem. So they did grow sales, general, and admin, but not as much as Dollar Tree. So Dollar Tree had a massive growth, and it doesn't look like it was any acquisition or anything. They're just paying employees more, which that can be good. That's definitely good for the employees. Balance sheet, 685 million cash versus 3.4 billion long-term debt. Dollar General has 537 million cash, so a little bit less in cash, 769 million short-term debt, and 6.2 billion long-term debt. So they do have more long-term debt and less cash than Dollar Tree. So that's going to give a point to Dollar Tree. And then cash flow, they are producing cash flow. Their CapEx has jumped huge, just like Dollar Tree's, but they're still producing free cash flow, and the majority of their cash has been going to share repurchases. But recently, they've just been paying a dividend and reducing debt a little bit. Okay. So Dollar Tree's still buying back shares. Dollar General is not. So that's going to be interesting. That could be management just being scared if the price is going lower, but you want them to be buying back prices at a cheap. You want them to be buying back shares at a cheap price. You don't want them to be just buying back willy-nilly. And it looks like they were just buying back willy-nilly until 2023. And it looks like I wonder if the map to Dollar Tree looks similar. So 149 was its peak over here in the last year, dropped to 66. Dollar General, I'm sure, is a similar story. Most recent year, it peaked at about 160 and is half that now. So they were buying back shares back there. I mean, maybe not back there, but since they haven't bought since 2023, but You do want them to be buying back cheap shares, not just shares consistently. If you dollar cost average, it's fine because then you're going to take the result of the business. And if your business is growing, that can be a good result. But you want them to be specific and strategic with their capital allocation, not just willy-nilly buying anything. So, yeah, so that was the comparison there. Let's get to present value of Dollar Tree. So Dollar Tree, I think, can grow probably 6-7%. Let's do 6%. I think they'll be able to increase, locations 2 or 3%. Inflation is going to be 2 3%. Demand maybe right in line with that. People love cheap stuff even in a downturn of economy. So I think it's not recession proof, but I do think that it's more recession proof than those a medium business. I think the really bougie stuff, really expensive stuff, is also as closer to recession proof than not. But I think the mid tier things where people can go to somewhere cheaper as an option, I think the cheapest option is going to be the cheapest option, and then the bougiest option are going to be the most recession or closest to recession proof. So I think that 6% a year seems fine to me. They do have a little bit of debt, but I'll put a market average return in PE with margins of 5 and 4%. They are buying back shares now. It's just whether they can get to that 4%, those margins right there. Let's do 4 and 3.5. Again, I'm scared that sales general and admin jumped up like crazy. That could be a problem. So share change, 1% for them is about 145 million. 245 million, or let's say 150, 300, 400. I think I'm comfortable with a 400 million share repurchase, which would be 2%. Just a little bit going to acquisitions and reinvestment. And we're saying it needs to fall 24% before you get the return link for here. So we saw that in the most recent year. From its peak this year, it's down in half, similar to Dollar General. So, those are the places to start, but you're really going to have to understand the business and see if they can get back to those old margins. I think if they can, this could be a great opportunity. But if you don't understand the business, it's just not even worth it to, or if it's worth it to look at, if you try to understand it. But if you can't understand it after doing research, don't invest in something that you don't understand. But right now, it looks pretty darn close to something that I could consider interesting. Hope you enjoy the video.